So this is just a remake of the video I made earlier, and it's just basically stating that I'm bearish because institutions are bearish. This is the Williams Money Flow Index. Smart money is bearish right now, and I mean I personally we're close to resistance, and for how fast it's moved in the short amount of time, it fast movement is not necessarily good. We So this is the weekly, and if we were to just kind of clean it up a little bit to where it's not so bad. I mean, we can like close the eye here. Yeah, we'll close it. So like this is the weekly resistance here that we're watching. If it were to close the week above this weekly resistance, then I would be wrong. I would flip bullish. But the thing is, we haven't even tested this area because we're so close. The risk to reward doesn't make sense to go long. And if we look at the RSI on just the daily and all the other time frames, we can look at it roughly here. We'll open up FX Choice. It'll pull up all the RSIs of just the different time frames. It's pretty overbought. And then on the weekly, we got we're pretty we're close to 50, and that's weak in terms of like performance. But the main argument I wanted to make was that we're overbought on the RSI, definitely in tech. We're getting close to what is that? No, that's the Dow. We're close on the SP 500. We're almost at 68. 68 is when we'll get overbought. And I really think when we get in here to this area, we'll be overbought. I mean, we've moved so far so fast that I see areas where it didn't even get to retest. That we put this back on, like we have a naked H4 breaker here that's never been retested. And once these opens, once we get into the December, I think around non-farm payroll on the second, we're going to see all these opens move all the way up here, and it's going to be really appealing to short. And but basically we have a naked H4 breaker here. We have a naked H4 breaker here that's never been retested. We have a naked H4 pivot here. I like to think that these things are magnets on the H4 naked pivots, and that it's going to go there. This is the naked pivots, and there it is right there. It's just a huge. It's never really been retested on this side. This is kind of like a huge imbalance. There's like so much. The imbalance is technically from the high of the candle before it to the low of the candle after it, and that's a huge imbalance. So it's gonna want to come into there and test that. So because of that, like, there's a huge chance it could get squashed because there's so many areas that it needs to retest. It needs to retest here. It needs to retest here just to see if it can, for the green light to go higher. Right now we're in a fair value gap, and it's on the daily. Fair value gap is basically the same thing I did with the H4, but it's on the daily. I like the daily and the weekly fair value gap. So the candle before, the candle after, and the wick. This is the fair value gap we're looking to fill, and we're expecting high resistance where the bears would step in right at the edge of the fair value gap, especially at the weekly resistance that we see right there, and a close of the gap or whatever it would go to. But we expect to fill it at least in some way, and to get rejected, and that's kind of what we're looking for. Non-farm is on the second of the weekday. That's on Friday. So this weekly close will show us a lot. I'm expecting it to spike above and then get rejected and close beneath on the non-farm day. I expect it to purge the bears, and then that's the swing. Was it the stop hunt would be in, and then it will begin its descent down. And other things to pair that with would be, so I took the S&P 500 index from Timing Solutions and that data feed, and I applied smart cycle, math cycle with Q Spectrum 2. It grabbed a whole bunch of these cycles, just small term that it can apply and make a committee line. And then I took the best walk forward analysis cycle, which is this trading spectrum. Applied this formula, found the best, what's it called? A cycle for walk forward analysis, and we're in the middle of the impulse to the downside. So with the institutions being bearish and the walk forward analysis being in the middle of the impulse to the downside, that any kind of peak that we hit here, like especially 12.3, and if you paid attention, when is NOMFOM? NOMFOM is on the 2nd, on Friday. So this is saying that the peak, we're rolling over after NOMFOM, and then we're going to go to our low, whatever that may be, and however fast that may be. And I don't know, we'll see. We have to the end of this week, and we need to see the weekly close because it's going to test that area, and then we're going to find out just how strong the bears are. If the bears are not strong, it'll be evident. We'll have a weekly close above the resistance, weekly resistance that we have there, and weekly resistance is this purple line, and that's what we're looking for. We're looking. It's just too soon to go bullish right now. If you wanted to go bullish, it was supposed to be way back on this weekly retest here on this down candle into a bullish order block here on a smaller time frame. But that's pretty much it. That's my base case. My base case is that if we were to come back, there's a lot of momentum to the downside that we could see. There's fragility with oil, if we look at oil, we look at the Brent weekly. We had our retest resumption to the downside here, and this is it looks like according to this, we had a nice I guess it's an outside candle. It's an outside candle. So it's bearish, but we didn't close below the low. But we did close below the weekly support. Weekly support is there. So that's actually significant. Weekly support, it's just as bad as weekly resistance. So if we go to West Texas Oil Crude, right there, and we were to do the same thing, that weekly support is the down candle before the up move. Weekly resistance is the up candle before the down move. And this is the support, the down candle before the up move. And we close below it. So we're going to come back and retest here. And we're going to make a bear flag. That's basically it. And then the same thing applies to crude oil. So we're in the middle of breaking down on oil on the weekly. Here, we caught right above the wick low, but it's going to come back. It's basically going to form a bear flag here too. It's going to just chop around. It's an outside bar. We closed the week below support here, but we did stop above the swing low, and that's a little bit of hope. But the thing is, we have to get above weekly support in order for it to be like a swing failure pattern for bullishness to the upside. And the thing is, if the market is weak going up on this next leg, that means that oil's next leg will be weak too in this retest. And that's kind of because we're overdone on the RSI on both the Dow and the S&P 500. We're about to hit 68. We're about to be spent on that RSI, and it's about to be overbought big time, especially in the Dow. But that's the biggest case that I can make in the technicals, and then throw in Jim Cramer in there. Jim Cramer is so bullish for December, it's kind of crazy. So the fact that Jim Cramer is bullish, is a huge kind of tell, and he's bullish on oil too, as to there's fragility and there's a high risk to the downside. We moved up really quick, really fast in a short amount of time, so that should say just how much could be, how many gaps need to be filled to the downside. And if we were to just highlight gaps, I don't know, maybe I've stated enough of my case. I mean, I went through the RSI, I went through weekly resistance and weekly support, the case of oil and its fragility, the case of S&P 500 and its fragility with the untested breakers and naked pivots, and just weaker and weaker legs. Like this was a huge strong leg, this was a little bit weaker leg, and this is going to be even weaker once we come up here. And it's just a huge rising wedge. There is no way you want to bet on this rising wedge unless we have a nice, strong weekly close. And I think it's going to just come down to non-farm payroll. That number is going to decide a lot. And based on just kind of what the forecast is saying, you want to bet short. And institutions, they're saying you want to bet short. Jim Cramer, he's saying you want to bet short. So that's kind of just the overall message I wanted to give in a short amount of time on just the analysis of what I see. And if I wanted to put more sugar on top, I could talk about what I see with the Japanese yen. The Japanese yen looks crazy. We'll open up the second instance of MetaTrader 4 because this one has just the index itself of the yen. I'm not sure if I clicked it fast enough. Okay, looks like we're going. Yeah, here we are. So the yen, the Japanese yen. So here's the swing failure pattern right here. Basically left shoulder, head, and then right shoulder. It's forming right there. We had a nice move up. Let's see. I almost think, we had a nice break in structure. I think this is a daily order block on the up candle right there, and we closed above it, and then now we're kind of in a huge retest, and we're holding this swing low, roughly, I think, or this order block. I don't know what to call it really, but the down candle before the up move. So technically, this is the order block on the weekly, starting right there, and we're almost ready to break out to the upside. This double bottom kind of thing, or the swing failure pattern where the bears were wrong in this. This strength in the yen is concerning. I mean, it's already broken the daily. We've broken the daily here. I don't know if we're going to come down. Like, I think maybe that last move up, maybe will settle us down a little bit, maybe for the retest here. But it's really strong. I mean, it hasn't even come down to retest down here. So that is a signal of its strength. But, we've already broken the daily. We've tried to break down on the H4 to go retest the daily, but it's so strong that it pretty much canceled out whatever the bears on the yen were doing. And this is a risk-off currency. And for the yen to gain strength is a big signal. And then the dollar to have a lot of weakness, it's another signal. Like, a lot of people are thinking that the dollar will come back. I'm thinking the dollar is toast, and because of the yen. And whenever the yen gains a lot of strength and is threatening, then the dollar will get really weak. The U.S. dollar, I would say, is a risk-off currency for a stable inflationary environment. But whenever it's recessionary, the yen is the one that gains strength because it's so cheap. And in comparison, the dollar is so expensive. And I expect the dollar to come back, but not until we kind of go into demand all the way down here on these down weekly candles, testing this monthly bullish order block. But and then another indicator would be the euro. So the euro, we haven't made a higher close yet. We haven't closed above there on the weekly, and it's gonna try, I guess, one more time up there. But we hit the last week high. Well, I guess we didn't hit the last week high, but we had an inside bar. So it's trying to make a decision. Here we had an H4 breaker to the downside, and we're waiting to see what's going to happen. It's coiling up. It's not conclusive really, but looks like a huge rising wedge to me, to where it could break down. Like, a lot of people are putting a lot of faith in this move, that that it's bullish and it's not coming back. But the thing is, I just think people just don't have the chops for just great assessment, for doing their homework. Like, you gotta figure out where you're wrong and where the thesis makes sense, or where you're right. But yeah, here's the huge rising wedge. I don't know. Maybe we can make it more in line with all the other highs here. Yeah, maybe something like that. Huge rising wedge, and but yeah, like, we're just waiting to see what happens with oil, what happens with the yen, and what happens with S&P 500. And I don't know. I'm still bearish on gold, even though we had a breaker to the upside, and it looks like it's holding. I don't know if it's going to be able to survive what's to come. Like, I know gold is really volatile. I don't know. It's more volatile than what I can handle compared to Bitcoin. It's just really difficult. Right now, it's the favor is in the bullish side, but once we start to have some panic, and here's some context: we're so close to like a bearish view. Like, if we get dip below that 150, and we take out that low, then say sayonara. It's not like healthy at all. We got a small chance. I mean, this setup doesn't look that great. It looks kind of weird. I mean, we got this kind of swing low here. We're holding this swing low, but if we take out this low down here, it's toast. That's basically it, and it's just I don't know. With us being so close to really non-farm, that I kind of want to wait. I want to wait to see what happens, and if the force is so strong that the yen gains strength, because what could steal the glory of the gold would be the yen, and the risk-off nature currency that it provides, versus gold is more for stagflation. And I think that's what gold, the pickup in gold is all about. The pickup in gold is about the stagflation, and people and speculators see that, hey, we're heading towards stagflation. And yes, I do believe that we are. Like, I am willing to buy long in gold, but still there is targets below us of liquidity that I see that we could still hit. And if we were to just use this weekly chart here, we could try looking at gold and see what we see. And right now we're still under a bearish breaker. Right now it says bullish, but we haven't broke through this breaker yet. And obviously, weekly resistance right there, we haven't closed above it, and we're actually into weekly supply, and that's not a good thing. We're kind of in between a nested breaker. Maybe that's an H4 in there. Yeah, there's some H4 breakers in there. There's a H4 breaker to the upside, H4 breaker to the downside. So this nested breaker is nasty. It's so choppy. You have no idea what's going to happen. And this is the thing I try to avoid, this nested breaker. It's just so confusing. And that's kind of what was going on with S&P 500. And I just did not like it at all. And let's think, were we on the weekly here? Yeah. And see, we got this weekly untested breaker here that we could head to. We could move to it. Let's see. Say we go to the weekly resistance. We come down. That's roughly 25%. And I think that's totally possible with everything in free fall, like if oil and commodities are coming down, and the whole market's coming down, and maybe bonds go up a little bit, like TLT, and the yen. Then I could see gold falling. Gold is not immune to falling in something that's like a scary surprise number. Gold is still susceptible to downside risk. It's not the same amount as oil. Oil can drop 40%. Gold can drop 20%. and then the S&P 500 could drop 20. So it is outsized in its impact that it can have, but by no means do I think gold is immune to dropping. And at the same time, I'm open to being wrong if we close the week above the weekly resistance. And just right now, I'm not impressed because of the outsized downside there risk there is. The downside risk is a really good reward if you were to just go for short, and it just makes sense. Like obviously, the downward bias is not favorable in terms of people who are used to buying long only. But in terms of like a risk to reward, it just makes more sense to go short than to go long right now because of the fragility that's currently in the markets. Whether you look at the treasury inversions, it's like mega inverted. We got like signs of contango in oil. We got signs of just fragility in the credit spreads. Right now, the credit spreads are under fire. They're trying to pick it up. I mean, we're under a weekly breaker. It says bullish, but we're under a weekly breaker, and until we make higher highs, and we haven't, we've made lower highs, and we need a close above this high. We couldn't even get a close above this high, and the fact that we're having lower highs on the high yield growth credit spreads is showing that it might not be going up in the direction we would want into strength. It's actually getting weaker on the credit spreads. And then we go to the corporate credit spreads, and it came so close. We are so close to closing the week above and having a higher high. But the thing is, we didn't close above, and we got a gap below, and we got two gaps below on this corporate credit spread, and technically we're still bearish on. I think there's still a breaker. Maybe this is the breaker here. I think we moved up above it, but we're into supply, and as long as this supply shuts this candle down, we're still bearish, and we're going to go back and fill all those gaps, and that momentum to fill those gaps is going to be so strong. It's too much on the credit spreads, and that gives a signal of weakness in the market that nobody wants to touch, especially going into December, where all the traders are trying to wrap up their books, and they just don't want to deal with the risk for it. So instead, they're just going to hedge. They're going to hedge, and they're going to try to protect their downside, and that's going to result in just poor liquidity. It's going to result in people putting on some puts to hedge against the downside. That downside risk, with it being 20%, it's still a big risk, and it can, we take the stairs up, but we take the elevator down. The downside is able to appear much quicker than the upside. So I think with us going into the last month, the monthly close is going to be important. This weekly close is going to be important, just because it's going to really tell who is really in control. Right now, it's still leaning bearish on a lot of, whether it's the oil, whether it's the S&P 500. I can't speak for the Dow, but I can tell just the fragility that's there, and just the different forms of liquidity, whether it's just the outsized gigantic inversion in the yield curve, or it's the credit spreads not turning bullish yet or having higher highs. That kind of makes you uneasy, like something's fishy. And then all you have to do is look at what's the leading sectors in the market. The leading sectors in the market are defensive. You got consumer staples in the lead on the RSI strength. You got industrials coming second, and then I think you got materials coming third, and fourth healthcare, and then utilities fifth. So that's a huge defensive lineup. So there's a lot of fishiness that people are sniffing, and it's not a show of a risk-on market by no means. And I think people are kind of sniffing out what's the retail sales going to be like. And so far, we've gotten some news to say that it's doing well according to Adobe, but it's not over yet. It's not over yet. And consumer staples is leading the market. So if consumer staples is leading the market, how in discretionary is the bottom sector? How in the world is that report right? So that's kind of my beef with that news coming from Adobe Analytics is that if that news is correct, whether it's from Macy's or whatever store, discretionary sectors like in the crapper, it's the weakest sector. And then we got the risk off sector, consumer staples, is the strongest sector. What does that say? So that's kind of my beef. Something's fishy. We don't have weekly closes over resistance, weekly resistance, and until that happens, I'm still bearish. So until that's proven wrong, I'm gonna be waiting until there's a stop hunt, a test, and then I'm getting a position in short. End of story.